Welcome to Lunch Money. We are so excited that you decided to join us for lunch today. I'm your host, Nikema Boulware, Business Development Executive here at Guardian Credit Union, and we are so happy that you are here with us. You are definitely in for a treat today. Now, this is for those of you that joined us before, you know that this is our second part of a three-part series on credit. So, in our last episode, we talked about what credit is and why it's important. We also discussed and broke down the understanding of being credit worthy, your credit report and the differences in your credit scores and the types of credit that actually show up on your credit report. We also talked about how credit impacts your life, and we gave 3 credit habits to money smart people. Now, I am so very excited because we have a very special guest with us today, an expert by all means. And I'm going to go ahead and allow her to introduce herself today.
Sure. Hi, I am Melodie Wright. I am the AVP of Lending here at Guardian Credit Union. And I have had the pleasure of helping membership with from all different walks of life, different credit circumstances for 13 years here at the credit union. And I got to say, I watched the last episode and I'm very excited to be here today.
Well, wonderful, Mel. We are so lucky to have you here with us as a partner, a part of our team here at Guardian Credit Union, and we are excited about what we're going to get into today. Today, we get to dig a little bit deeper. Mel, why don't you go ahead and share with us what's on the menu?
So today we will be talking about how to establish your credit, managing your credit effectively, maintaining your credit, and 3 credit habits of money smart people.
So we're really excited today because we get to answer some questions that a lot of our members ask all the time. One being, how do I even establish my credit? And what that really means, Mel, is how do I even get a credit score?
Sure. So to get a credit score, you need 1 trade line with a payment history of 6 months plus activity reported in the last 6 months.
Well, that's some good information, but Mel, what is a trade line again?
So a trade line on your credit report would be any type of installment or revolving debt you have taken out with a creditor. So say you apply for a credit card, a personal loan, car loan, mortgage. Those are considered trade lines when they are reported to the credit bureaus.
Okay, perfect. And let's talk about now how I'm actually going to establish credit so that I can start getting those trade lines.
Yes. So there's several different options. One of the easiest options would be a credit card, whether it's a secured credit card or unsecured. If you have no credit established, it may be a little bit harder to get an unsecured credit card off the bat. So you may have to put up your own money for that credit card, which just means you may want to save up $500 to $1,000, have it in a savings account. The credit union will issue a credit card secured with that money in your savings account. That's a great way to get established. We also have something called a Credit Matters loan that we offer here at the credit union.
Okay.
That Credit Matters loan is something that will also get your credit started. That is considered installment debt. You have monthly installments of the same monthly payment every single month for a set term. So say you get a $600 Credit Matters loan with a 12-month term. You know you're going to have it paid off in 12 months, but you've got that installment debt on your credit report. That's a great way to build a credit score. A third option would be asking relatives, parents, grandparents, if they would add you as an authorized user to their credit cards. That is also another way that you could establish credit.
I want to ask you a little bit more information about the authorized user. I think some of our members think once they are on the credit card as an authorized user, then that's pretty much it. But one of the things that I want you to kind of talk through a little bit, if that person, you're essentially joint with that person's credit for that particular trade line that they've allowed you to get on, such as the credit card. Talk about some of the things that happens to your credit once you are authorized. If that person misses a payment, if that card happens to get closed, or if they're using the card perfectly fine and continue to be in good standing.
That is a great point. Great point. You would want to make sure that the person you are going to be added to their card as an authorized user has a good credit history and makes payments on time, because if they don't, it will actually have the opposite effect and hurt your credit. Once you're added as authorized user, that credit card will show up as a trade line on your credit report. As long as those payments are made on time, then you should establish a good credit score.
Well, that's some really good information. And I think our members will appreciate knowing that they have different options to get them established with their credit so that they'll have an actual score. But what I'd like to talk about now is kind of transition into what we do once we've got that established. So let's talk about managing your credit.
Absolutely. So when I think of managing credit, immediately I think about the utilization of my credit card limits, because revolving debt can increase your credit score in a very short amount of time or tank your credit score very quickly. Revolving debt is the hardest type of debt to manage. And so when I talk about credit card utilization, I'm thinking of credit limits. If I have a $10,000 credit limit and I owe $5,000 on that, then I am 50% utilized.
Right.
And so I am essentially losing 50 points.
Wow.
If I were to pay that $5,000 credit card off, I gain 50 points back in my credit score.
Okay.
So that's essentially what we mean with utilization. Like how much are you utilized?
And then when you think about capacity, I know that was one of the topics that we talked a little bit about in our previous episode. When you're talking about capacity, can you explain that a little bit in reference to the credit card?
Absolutely. So, the higher the capacity, the better. And basically, you want to always make sure that you have higher dollar credit limits, and so that you have the largest capacity, because emergencies happen. And if you have a $500 credit card and you need a $500 set of tires, you've maxed out that credit card, you've lost 100 points. So you want to have the higher capacity. You don't want to have 50 credit cards, but more than one credit card would be good. You want to have a few credit cards with substantial credit limits in case of emergency, so that you don't max them out and lose that many points in your credit score.
That's some really good information. So capacity really is that limit that you have on those credit cards. It opens up the door for you to be able to manage your revolving debt more effectively, because you have a little bit more that you can spend and still have some left over, and you don't have to worry about losing those points when you're utilizing those credit cards.
Exactly.
Great information, Mel. Thank you so much for providing that. And also, to remember, as we're going through our talk, make sure you utilize the chat feature, because we want to answer any questions that you have. We want to make sure we get to them in the Q&A. So, Mel, one of the things that you also mentioned as well when you're talking about managing your credit, you were also talking about installment debt as well. Can you talk to us a little bit about managing your installment debt?
So once you get your credit established, it doesn't stop there. Don't quit. Don't open that credit card or Credit Matters loan and then think, oh, I've got a credit score now, I can sit back until I need something. Because if you pay everything off and you go 6 months without no activity, you go back to a no score. So with revolving debt, it's always good practice to, never charge more than what you can pay off in the same month. So charge it, wait for that statement to come in the mail, then pay it off each month. And with installment debt, you want to make sure that you avoid payment shock. We all get blinded by that shiny new car and the big house with the pool. And so you don't want to create payment shock. So make sure that when you're talking with your financial advisors at the credit union, that you are talking through your budget and realistically what you can afford and what all goes into that, because that shiny new car also comes with car insurance.
It does.
Your house comes with homeowners insurance, taxes. So you got to think through all that.
And I think so too often, like you said, the shiny a new car, we know about a house, we know about the insurance of a car, but we don't think about the maintenance. You mentioned before that credit card that you may have to buy those $500 tires for. Well, what if your a set of tires is $1,000 on the new vehicle,
Right.
and you only have the $500 credit card? So you want to make sure, like you mentioned before, you're keeping that in mind. And installment debt sometimes can get swept under the rug because you mentioned before it's a set payment every single month. You're going to pay the same amount, and the revolving debt kind of, as you pay it, it goes down, and it's available for you to use again. And sometimes you can be blinded by the fact that you know what you're going to pay every single month and you can budget it in, but you don't think about the other things that fall into that. One of the rules of thumb that you mentioned before, in installment, was not getting more than what you could afford. Will you talk a little bit about that when it comes to real estate?
Absolutely. So, housing markets are hot, but prices continue to climb just as vehicle pricing. And so a good rule of thumb is to not purchase a home that is more than 2.5 times your annual income. So that's just a good rule of thumb to keep in mind, 2.5 times your annual income.
And so when you say annual income, I just want to be clear that our members and our listeners understand what we're saying. Is that pre-tax income or after-tax income?
Well, from a creditor standpoint, we're going to look at your gross income, which is pre-taxed income. However, as a consumer, I would go by my take-home pay. Like I would look at what you bring home in that year after taxes, retirement, anything else you have coming out. That is the safest, best way to look at it for you as a consumer.
Well, Mel, you've definitely given us some great information. And again, make sure you use that chat feature, because if you have any questions or you have comments about any of the information we provided, we want to hear from you, because we definitely want to get to you in the Q&A session at the very end. Now, when it comes to maintaining your credit, most often members think that making your payments on time is the only thing that you have to do and you're pretty much done. But maintaining your credit is way deeper than that. Why don't you go ahead and talk a little bit about how to maintain your credit?
Sure. So making your payments on time is number one. Absolutely number one. Making your payments on time, that makes up 35% of your credit score. So that's a big one. But you also have to make sure you have the right mix of credit. You can't just have all revolving debt like credit cards, and you can't have all installment debt. You need to have the right mix. And again, for most, you're looking at maybe a car loan, a home loan, maybe a personal loan if you needed it for a big expense, and then just a few credit cards. You don't ever want to go out and just get credit from everywhere.
Right.
And it's easy to do. It's in our face. There's advertisements. I was shopping online the other night for shoes and gave me the option to pay for those shoes in 4 monthly installments. No, don't fall for that. Don't do it. Anyway, a good mix of credit. Make sure you keep your credit going. Again, we've already mentioned if you pay everything off and you have 6 months of no activity, you'll go back to a no score. So just always keep your credit going. Even if you don't want to use that credit card monthly, that's fine. At least once a quarter, charge a tank of gas on that credit card.
Perfect.
Lastly, I want to talk about consolidation loans, because it is so easy to get into trouble with revolving credit card debt. If you max them out, the best thing would be to do a consolidation loan. And let me tell you why.
Okay.
The credit union does a consolidation loan for you, and that would be an installment loan. You would have a set monthly payment every month for a set term, so you know, hey, in 4 years, I will be debt-free, and we will pay all your credit cards off for you. We recommend leaving them open. We don't necessarily want to close them because we want that capacity. Now, if you have a lot of credit cards, we may recommend closing them, but it's going to be more of a discipline type thing for you not to charge them back up. Absolutely. But if we pay them off, you will immediately have 100 points increase in your credit score because all of a sudden your revolving debt's gone. We've got this installment debt now. And so we have freed up 100% capacity on your credit cards.
Absolutely. And in maintaining your credit, you want to know what's available to you to do that. I think often we have members that say, you know what, I'm so far in debt, there's no hope for me. But having that conversation, connecting with us, making sure you're having a real conversation about where you are and really where you want to be does allow you the flexibility to potentially get a consolidation loan that will then open your credit back up so you're maintaining it and getting it back to the place that you wanted it to be at first.
You are correct. Yes, ma'am.
Absolutely. Well, we're so excited because we're down to our money tip for today, and we're going to be giving you 3 habits of money smart people. And Mel, I'm going to let you take it away.
Absolutely. So, number 1 would be avoiding finance companies.
Well, let's talk about why that's important specifically.
Finance companies are on every corner. You can see 20 finance companies on the same block, and they make it easy. You go in, you're in and out in 20 minutes. But what happens is they actually hurt your credit score because they can report more of a revolving type credit. It's a loan, and you don't think of it as a credit card, but these finance companies typically renew your loan every 90 days. Mm-hmm. You're going to get a phone call from them. They're going to say, hey, you've paid your loan down $200. Do you want to renew and go back up to $500? It's so easy to say yes, but then guess what? There's another trade line that shows up on your credit report. And so it's a never-ending cycle, and all those trade lines, every 90 days, you get another trade line added by that same finance company because you keep renewing. It ends up working more like revolving debt, and it tanks your credit score. It really affects you. So if you can't, plus their interest rates are through the roof, and your credit union is here to help you in times of need. We don't want to get you in this vicious cycle where you're constantly borrowing. We want to give you the steps you need for financial freedom. So Absolutely. Come to us first. Our interest rates are much, much lower. And we have certified credit counselors at every branch location that can help explain all of this to you and more.
That's a really great tip. And I think so often, like you mentioned, it's just easy. And sometimes people just don't know that they can go and come right here to Guardian, and we can sit down with them and counsel them and get them to the place that they want to be. That's a really great tip.
And if you do have an emergency, we've got personal loans at a much lower rate. So that should have been tip number 1. See your credit union first.
Right.
I'm changing that.
So tip number 1 is see your credit union first.
Yes.
And tip number 2 is stay away from finance companies.
There you go.
Let's go ahead to tip number 3 then, Mel.
Okay. Do not max out your credit cards. Don't. Say we have that $10,000 credit limit, mm-hmm. and my daughter's got a wedding coming up. Well, I got that $10 available. It's very easy just to put that $10,000 on that credit card. But remember, you'll be 100% utilized on that credit card. And if that's your only credit card, if you don't have any other credit cards open that have open credit limits,
that's right,
you will tank, your credit score will tank 100 points.
And I remember what you said. You want to make sure whatever you put on your credit card, you can pay it off at the end of the month. You don't want to spend more than you can afford to pay monthly.
Yes, ma'am, you are correct. In those situations with the large purchases, that's where I would recommend a signature loan from your credit union. Come to the credit union, let's do a $10,000 signature loan, and then you've got a set monthly payment every month, a set interest rate, and you can choose your term, whether you want to pay it off in 12 months or 36 months. That way we can play with the figures and get a payment that works within your budget, but you're going to have it paid off in a set monthly amount of time. Absolutely. And you're not going to tank your credit score. So definitely for large purchases, go the signature loan route instead, or even a home equity line of credit. We also offer those here at the credit union. And of course, credit cards are good in an emergency, and don't panic if you have an emergency and you need to use that card. That's absolutely fine. And you can work to pay it off, or if it was a large emergency, come to us and we'll do a signature loan to pay that credit card off.
Okay. And then today, because we get an extra tip, why don't you give us our 4th tip for today?
Okay. All right. So final tip of the day, contact your creditor before you are going to be late on your payment. things happen. We get sick, we lose our jobs, we transfer jobs. I mean, we're human. We realize things happen. But before you are late on that payment, reach out to your credit union or financial institution, reach out to that creditor. They may have options to help you that won't negatively impact your credit score. Because remember, just so much as one 30-day late payment can decrease your score rather drastically.
Oh, yes.
You could go from A credit to C credit with one 30-day late payment. Don't be afraid of your creditors. We are here for you. We want to talk to you. We want you to be successful. So reach out beforehand, and more than likely, they will be able to work out a plan that will not negatively impact your credit and keep you on track.
All right, we are down to our Q&A, and we are so excited because you all have been great today. You sent a lot of questions in, so we're going to go ahead and jump in. But I would like you to know, if we don't get to every single one of the questions that we have submitted, just know that we will be answering each of them and directly to you and sending them out to the group as well. So our very first question is, Hello, I wanted to know about credit score changes once accounts are paid off and why your score goes down after closed accounts. Mel, why don't you go ahead and answer that?
Sure, that's a good question. So typically, when you see a credit score go down after a paid and closed account, it's usually a revolving trade line.
Okay.
Again, we don't recommend closing revolving trade lines, even if you've paid that card off, simply because if you close that card, then you decrease the amount of capacity available to you. And if you remember, the more capacity you have available, typically the higher the credit score. So we don't recommend closing out revolving trade lines. You shouldn't necessarily see a decrease in your score if you pay off an installment debt, like a signature loan or a car loan. You shouldn't see a decrease there. Now, you can see a decrease when you add a new trade line, and that's because the length of your credit history also impacts your credit score, even though minimally it does. And so when you open new credit, you'll see your credit score decrease slightly, but usually after 6 to 12 months of on-time payments, your credit score is going to go back to where it was or even higher.
Absolutely. And I remember you mentioning while we were talking through our discussion, you also said that sometimes when you do use those finance companies and those lending places, they report your loan, you thinking it's installment because you're paying that monthly payment or that biweekly payment, but they are actually reporting it as revolving credit. And sometimes when you pay all of that off, it could potentially let that score drop as well.
Right. So with finance companies, even though it isn't technically an installment loan with a set term, what happens is they're reporting as a finance company, which does negatively impact your score versus if you had a bank loan, credit union loan, that type of thing. And yes, what happens is you typically renew a finance company's loan over and over and over. And so you've got a new trade line hitting your credit report every 90 days because you keep renewing that.
Right.
So again, finance companies, they're great in emergencies, but still remember your credit union is here in emergencies. I just want to hone in on that point. They're there. I know they're quick, they're easy, but again, if you need it in an emergency, say it's a Sunday and they may be open, that's fine, but just don't get in a habit of renewing that loan over and over. Don't get into that cycle where you're constantly borrowing, because basically you're just inflating your income. Then you start relying on those loans to pay your bills.
Absolutely. Well, that was a great question. We have another one. If you have a credit card and you max it out, will it hurt your credit score? Also, if your credit card is $500, what amount should you spend each month if you're trying to build your credit? So that's a two-part question, Mel.
Okay, so yes, maxed out credit cards do impact your credit score negatively. Again, when we go back to capacity, so I think we've used two different terms here. And so let me clarify utilization versus capacity. It's basically just the opposite of each other. Kind of like a half glass, is the glass half full or half empty? So when we talk about utilization, that's how much you've used of your credit card capacity or your credit card limit.
Right.
When we talk about capacity, that's how much you have available to use.
So that's your limit.
Right. Available to use. Say I have $10,000 credit limit. If I owe 5,000, then you can look at it either way. I can say I'm 50% utilized or I have 50% capacity,
Right.
that type of thing. So basically, for every percentage that you've used up, you're losing 1 point. So if I'm 50% utilized on my credit card, I'm basically losing 50 points. If you're maxed out, you're losing 100 points. Now, that's just talking if you have one credit card. If you have multiple credit cards, it all goes into one bucket. So
That's
I
right.
may have 5 credit cards at 10,000 a piece. So essentially, I've got $50,000 available to me. And if I only have 10,000 owed across all 5 credit cards, you're better than, just maxing out one credit card is not going to impact you so much as long as you have other credit cards open with capacity. Um, and as far as the $500 credit limit, so with a $500 credit limit, you want to be careful. Again, that is when I would encourage you to call your creditor and ask for a higher credit limit, especially if you've had it for a while, 12 months or more, and you've made on-time payments. Call them and ask them for a higher credit limit because $500 is really low. And so you put $250 on it, you lost 50 points. So that's not benefiting you. However, as long as you can pay it off each month,
Mhm.
that is what I would encourage you to do. So again, try not to charge more on your credit cards than you can pay off in 1 month, and just wait for that monthly statement to hit, pay it off. And again, for the large purchases, instead of a credit card, that's when we would recommend a personal loan,
Right.
signature loan type.
Absolutely. That was a great question as well. Now, we have a few more questions out here, but I wanted to get to this one. It says, how do student loans impact your credit? Now, we get that all the time at the credit union. So many of us
Right,
have gone to college and have student loans. I think that's a great question and could speak
right.
to almost anyone,
Sure.
young or, those that have graduated and gone to graduate school and other things like that.
Right, right. And unfortunately, with student loans, there's not one straight answer. So, to whomever asked this question, great question. And I would encourage you to follow up with one of our credit union financial counselors for more information on your specific situation. However, I can tell you this: if the loans are in deferment. Typically, they're in deferment for
Hmm.
6 months after graduation. You're not currently making payments, they have zero impact on your credit right now because there's basically no activity. They're
Right.
in deferment. You're not making payments. They're virtually not having any impact right now. If they are in forbearance, that could be negatively impacting your credit score. And of course, if you are currently making payments on time, then it's helping your
That's
credit
right.
score. So, again, please feel free to reach out and let one of our counselors help you with your specific
Right.
situation.
This is exactly why we want to make sure that you connect with us and you understand how important it is that every situation is completely different. Another great question that we have out here is, would it be smart to pay your utility bills on a credit card?
Sure. Yeah. To be honest, as long as you can pay it off, again, at the end of the month, absolutely. That's a way to keep your revolving credit going. Just make sure that you don't charge more than you can pay off each month. And I know here at the credit union and several other card companies, they offer awards. So, use that card to build points and use the awards program as well.
Yes, absolutely. Another question that we have out here are credit cards good for college students? We get this all the time at the credit union as well.
It's scary.
It is a little scary at first.
And I tell you, it is because the earlier you start building credit, the better. We love to get young people in. And if you're not aware, the state of Alabama did make a change sometime
Hmm.
last year, I believe. We changed the minimum age to 18. So at
Hmm.
18 years old, you can now legally sign a contract and obtain credit in your own name. So I would encourage you to start building credit as early as possible. But you have to be smart. And let me tell you, when you're in college, you're going to start getting tons of solicitation mail from credit card companies all over, Capital One, you name it. They're going to try to get you. But be careful. You got to be smart. Um, Please, young people, feel free to come into the credit union
That's
and
right.
sit down with one of our counselors to really understand how credit works, how to build your credit. Let's do it smart. We want to make sure, that you as a college student that you can probably easily manage one credit card with a smaller credit limit, but
Right.
you don't want to obtain several credit cards and get yourself in trouble early on, because if you come out of the gate and negatively impact your score because of not making smart decisions at a young age, that can impact you well into your 20s. And
Absolutely.
then, in our mid to late 20s, that's when we're wanting families, we're buying homes, we're buying nicer vehicles. So, you don't want to start off on the wrong foot.
Right. And make sure, remember, if you are a college student and you are looking to do that, like Mel said, go into your financial institution and get some counseling, but also have a conversation with your parents.
Mhm.
Remember, even though you're technically an adult and you're out on your own, you still want to make sure that your parents are aware of what's going on, because they may be able to offer you a different option, maybe being an authorized signer on a card that they have,
Right.
or just making sure and holding you accountable for the choices and decisions that you're making. Now, I know we're at 1 o'clock, and I promise that we want to stick to your time with our lunch money and only take 30 minutes of your day. But we do have one last question that we do want to get to. We have a high volume credit card debt. We have high volume credit card debt. Can we get a consolidation loan to pay that off?
Sure, absolutely. So we would love to look at your specific situation, and that is what we recommend in those situations. If we can look at the number of cards, the balances owed on those cards, and if we can roll them into a consolidation loan with a set term, typically we don't recommend more than a 48-month term. That way, I'm going to have a set monthly payment, I have a fixed interest rate, and I will be debt free in 4 years. And we will look at your entire situation and determine if we need to close some of those, leave some open. Again, we don't always want to close credit cards, but if we have a wealth of them, that may be a suggestion made by one of our counselors. Let's leave maybe the oldest trade line open, like the oldest credit card open, because again, length of credit does play into your credit score a little bit. But absolutely, we want to look at that for you and do a consolidation loan. You could see a huge spike in your credit score, probably usually within 60 days after doing a consolidation loan. So if we were able to pay all of them off, you could see as much as 100-point increase in your credit score.
Well, that sounds really great. And I'm sure our member or potential member would be definitely interested in that. We want you to connect with us. You can connect with us directly. You see right here on the screen. You can call our main number. You can reach us at myguardiancu.com/lunchmoney, or you can visit your local Guardian branch. Okay. We really want to make sure that you are connecting with us. And again, we are so appreciative that you decided to take time with us today, but don't you dare leave, because we have a winner in the mix today. Let's go ahead. Let me scroll. We're going to randomly pick somebody and we're going to provide lunch for you. Lunch on Guardian Credit Union. Drum roll, please. Let's see who this person is going to be. All right. Okay, it's pulling up. Here we go. It's random. So let's see. We have Deidre Harris. Deidre Harris, you are our winner. Deidre Harris. I'm sorry, Deidre. I'm so sorry. Deidre Harris, you are our winner today. We are so excited that you decided to join us. We will be sending you an email so that we can get your mailing address so that we can go ahead and get that over to you, or we can schedule some time for you to come in and see into one of our local branches. Again, Mel, we are so happy that you were here today. I know all of our members, potential members, listeners that are on today thoroughly enjoyed the time that you shared with us today and got some really great information. Even though we've gone on over a little bit, we just want to give you an opportunity to share something with the team before we close it out.
Sure. It was a lot of fun. Thanks for having me. And if we didn't get to your question, we will get to you individually. So don't worry about that.
That's right.
And please take advantage of our certified credit union financial counselors in all of our branches. And I look forward to doing another episode one day.
Well, I am so excited that this was the second part of our 3-part series. Our third part is going to be coming very soon, so stay tuned for information. Also, we're going to be talking about rebuilding credit in our third part, okay? So please come back and join us. Some of these questions definitely are questions that are going to fall into that actual episode, so we want to see you back then. Thank you again for joining us for Lunch Money. Have a wonderful rest of your day.